from where we left in our previous class. We were looking at borrowing costs. We were looking at borrowing costs. So I think that is under International Accounting Standard number 23. So IAS 23. So we have already introduced, we learned about what is borrowing costs, and I think we did one example. And I think I left an assignment. Because in this case, I told you you can be able to try to attempt it. So it is September. You can open this question, September 2021. 2021. Question is question number 4. Question number 4A. So I've sent the past paper in the group. So I want you people to confirm whether you've been able to access the past paper so that we can be able to move together. Confirm whether you've been able to access the past paper so that we can move together. Confirm whether you can be able to access the past paper. You just say yes in the chat so that I know, so that we start looking at the question. Have you people been able to access the past paper? I've shared it on the group. It is September 2021. Question number 4A. Always make sure that in this case, when you are joining the class, you can be able to access the past paper. You can be able to access the past paper. No one is confirming whether they're able to access the past paper. So I don't know whether you have it or you don't have it. I don't know whether we can proceed or we can't proceed. So I can see Leonard says yes. Only Leonard has the past paper. I can see Muteti says yes. Only 2 people have the past paper. So I think we can proceed. So it is a past paper for September 2021. Question number 4A. So the question says, maybe I can be able to go through the question. The question says it is about Darubini. So Darubini Limited has provided the following schedule of its long-term loans for the year ended 31st of December 2020. So there's a 10% loan note that I think will go up to the year 2025. So it was 300 million. We have in this case 12% bond. It will go up to 2028. It is a 200 million bond. We have 6% debentures, so it is 60 million. Then you are told that additional information, the 10% loan note and the 12% bonds were used to finance the construction of a power plant, which commenced on 1st of January 2020. Expenditure for the construction was drawn, with 100 million being drawn on 1st of January 2020 and 75 million on 1st of July 2020. 6% or debenture was used to finance the construction of a new storage facility. The construction commenced on 1st of January 2020, but no construction took place between 1st of March up to 31st of May due to COVID-19 restrictions. The facility was available for use on 31st of December 2020, having incurred a construction cost of 60 million. Required, in line with provisions of International Accounting Standard number 23, that is regarding borrowing costs, determine, number 1, the borrowing cost to be capitalized for each of the projects as of 31st of December 2020, then the value of the assets in the books of Darubini Limited as at 31st of December 2020. So if you can be able to recall, just a recap or a highlight about what we learned in our previous class, we said that in this case, when you talk about borrowing cost, is the cost that in this case you incur to borrow. The cost you incur to borrow. It can be, for example, in this case, what may be interest. And majorly in this case, most of the exam questions are basically focusing on what? On interest. So in this case, when you borrow money, in this case, when you borrow a loan, you're expected to pay what? Interest. So that basically comes as what? As a cost. But now we said, if you borrow a loan and it is involved in having to, for example, construct a qualifying asset. For example, in this case, you can be able to see this amount of money was actually borrowed to construct two assets here. So we have the power plant. There are two assets there. We have the power plant. The monies were borrowed to construct the power plant. Then, of course, also number two, it was the money was also borrowed. There was the 6% debenture borrowed to construct, in this case, the storage facility. Storage facility. Storage facility. Storage facility. Storage facility. So so these are the qualifying assets. The qualifying assets. And we said whenever you borrow money, and of course, you have a borrowing cost that has been incurred during the period under which the qualifying asset, is under construction, then that borrowing cost, you have to include it as part of what? The cost of that asset. As part of what? The cost of that asset. And of course, now in this case, what you can be able to see here, for example, the first project, if you look at the additional information, the 10% loan note and the 12% bonds were used to finance the construction of what? Of the power plant. Of the power plant. So this particular project here, they utilized two loans. They utilized what? Two loan facilities. Two loan facilities. And we said in this case, if there's a situation whereby, for example, there's the utilization, if there's the utilization of two loan facilities, then you determine what we call what? You determine what we call what? The capitalization rate. You have to find out the capitalization rate, the rate at which, for example, you'll compute interest to include on the cost of what? This asset, to include on this, the cost of this asset as a borrowing cost. Because there are two loans that are having to be utilized here. One has a different interest rate, another one has a different interest rate. But now you have to come up with a common what? Interest rate that in this case will help you determine the borrowing cost that in this case you'll be able to include on the cost of the power plant. So that in this case you can be able to know how much will be the value of these assets, for example, to be transferred into the statement of financial position. So if in any case we are having a situation where there is actually a borrowing and a cost has actually been incurred and a qualifying asset has been financed by two loans, you have to determine what we call what? The capitalization rate. The capitalization rate. So much importance, because in this case, our first question basically requires us to determine the borrowing cost to be capitalized. To be capitalized. So you'll be able to compute the cost to be capitalized for this particular project and the cost to be capitalized also for this particular what? Project. What they mean by the cost to be capitalized, the borrowing cost to be capitalized, they're simply asking us to compute the borrowing cost that we'll be able to include on the cost of this asset, on the cost of what? This asset. And of course, you said the borrowing cost incurred on the construction of a qualifying asset during the active period of construction has to be part of the cost of what? Of the asset. So in this case, our first thing to be able to determine, for example, for the power plant, simply because it was financed by two loans, then, so number one, for the power plant, it was financed. You can be able to take, right. The power plant was financed by two loans, and therefore we determine the capitalization rate. We determine the capitalization rate, because the two loans have what? Two different rates. We determine the capitalization rates, the capitalization rate. So the formula for the capitalization rate, we said, so the capitalization rate, how do you determine it? Where we have two loans. In this case, you have to take the aggregate interest, of the two loans, over the aggregate loan amount, or amount payable. So over the aggregate amount payable regarding the loan, over the aggregate amount of the loan payable, payable. So in this case, for the first loan here, the 10% loan note and we have the 10% loan note, and of course, in this case, you have what the 12% bonds were used to finance the construction of what of the power plant, which commenced on 1st of January 2020. So in this case, if you look at our table up there, so to get the aggregate interest rate, here, if we proceed, so for the first loan in this case, it was what a 10% loan note that was used to finance what this particular what asset. So the interest on the 10% loan note, in this case, it will likely be 10%. 10%. You can be able to put our figures actually in thousands. Our figures are actually in thousands. It will actually be 10% multiplied by 300 million. But now in this case, you add, because you agree, you know what you mean by aggregate, you add. So you have to add in this case also the interest rate on what the 12% bonds, because still they were utilized to do what finance the asset. So it will be 12%, 12% multiplied by, it is 200 million, 200 million, divide by the aggregate. So the aggregate in this case, you simply take what the total amount payable. So it will actually be 300 million plus 200 million. So you can do the computation, and of course, in this case, what is the rate you're having to get? If you do the computation, what is the rate you're having to get? If you do the computation, what is the rate you're having to get there? So this is the aggregate interest rate because it was financed by two loans. So the interest rate on the first loan, interest rate on the second loan over the total what loan amount. So what are you getting there? What are you getting there as the capitalization rate? If you do the mathematics, what are you getting as the capitalization rate? Eden, Betty, Brenda. What are you getting as the capitalization rate? The capitalization rate. What are you getting as the capitalization rate? You'll get 10.8. Okay, I will say 10.8%. It's actually correct. So you'll get 10.8%. 10.8%. So that is what 10.8%. 10.8%. So that is the rate that in this case you'd be able to use to compute the borrowing costs on the financing of what of the power plant. That is the rate you'll be able to use because there were two loans. You have to get an aggregate of the two. So you'll get 10.8% So now in this case, we can be able to, in this case, compute what the borrowing cost on the power plant. So the borrowing costs on the power plant. So now in this case, you're having to be told that in this case, the 10% loan note and the 12% bonds were used to finance the construction of the power plant, which commenced on 1st of January 2020. Expenditure for the construction was drawn, with 100 million being drawn on 1st of January 2020. And of course, in this case, 75 million on 1st of July 2020. So there were two loan facilities here, or two amounts here that were basically utilized in the construction. So one of the amounts in this case was from the start of the year, up to the end of the year, But another one was from 1st of July up to the end of the year. So to determine the borrowing costs on the first one, it will be the whole year. But this one, it will likely be half year because they started utilizing the amount from the middle of the year. So therefore, in this case, to get the borrowing cost on the power plant, in this case, we'll be able to take on the loan note, or in this case, on the first amount, in this case, that was actually borrowed, that is 100 million from 1st of January. You'll take the 100 million, multiply by 10.8% plus the other amount that was actually from the middle of the year. It was actually what, 75 million. So 75 million multiplied by 10.8%. But now it was for half year. You have to multiply by 6 out of 12. So what are you getting as the total borrowing cost on the two facilities? The one that was utilized from the start of the year, it is for the whole year. So we want, for example, a portion or a portion because it was for the whole year, utilized for the whole year in the construction. And this one was also utilized from the middle of the year. So what are you getting as the total there? What are you getting as the total borrowing cost? What are you getting as the total borrowing cost? The total borrowing cost, it is 14,850. So it is actually 14,850. Remember, our figures have already been able to indicate they're actually what? In thousands up here, in thousands. So you have to take note of that. They're actually in thousands. So that is actually 14,800 and what? And 50. So the borrowing cost now in this case on the power plant was actually 14,850. But of course, now in this case, it was not only the power plant that was actually having to be constructed. We have also what? That other facility that was actually having to be constructed. In this case, it was what? The storage facility. So you can, in this case, look at the borrowing cost on the storage facility. Hope you've been able to write this one already because I'm rubbing out. So now in this case, you can look at the borrowing costs on the storage facility. So the second part here, it is the borrowing costs on the storage facility. The borrowing cost on the storage facility. The borrowing cost on the storage facility. So for the storage facility, you're having to be told the 6% debenture was used to finance the construction of a new storage facility. The construction commenced on 1st of January, but no construction took place between 1st of March to 31st of May. So there was a period of inactivity. So that was actually what? 31st period of inactiveness. It was from, in this case, 1st of March up to, in this case, the 31st of May. So those are how many months? So the month of March, April, and of course, what? May, 3 months. So 3 months were actually what? Inactive. So it means that in this case, interest accrued over this period of time, you can't, for example, include it as part of the borrowing costs on the construction of what? This particular storage facility, because it was a period of inactivity during what? The COVID time. So it means they never took any kind of what? Construction. And we said the only borrowing cost that in this case you will end up having to capitalize, it is only that borrowing cost that in this case has been incurred during the period of activeness regarding what? The construction. So it means that in this case, when you compute our borrowing costs or the interests accrued over this amount for the construction of this one, we'll have to apportion it in a period of 9 out of 12 months. In a period of 9 out of what? 12 months. So therefore, in this case, our borrowing cost on the storage facility will actually be, so having incurred a construction cost of 60 million by the end of the year. So it will likely be 9 out of 12 times, it is 6%. It was a 6% debenture. So times 6% multiplied by the 60 million. 60 million. And of course, in this case, our figures are actually in thousands. So what are you having to get as the borrowing cost there? What are you having to get as the borrowing cost there? The borrowing cost there on the storage facility. The borrowing cost on the storage facility. It is 2,700,000. So it is actually 2,700,000. So the figure are actually in thousands. So this is the borrowing cost to be capitalized for the storage facility. And of course, this is the borrowing cost to be capitalized for the plant. In this case, the plant that was actually having to do what? To be constructed. So that is basically how in this case you determine what borrowing cost. Whenever, for example, in this case, maybe an asset has actually been financed by 2 loans, you have to determine the capitalization rate that in this case you use to do what? Compute the borrowing cost. Compute the borrowing cost. So the second part of the question in this case, the value of the assets in the books of Darubini Limited as of 31st December 2021. So the value of the assets, the value of the assets. So the value of the assets by the end of the year. The value of the assets by the end of the year, the value of the assets by the end of the year. So there were two assets here. So we have the power plant, and of course you have what? The storage facility. We have the storage facility. We have the storage facility. So the amount invested, so our figures will likely be in thousands. So the amount invested, so the amount they invested or they borrowed to invest here, there were two. So we had 100 million plus 75,000 for this one. So this one basically came to 175,000. So that's the amount that was actually invested. And of course, in this storage facility, they invested by the end of the year how much? 60,000. But now what they want us to be able to determine, it is the value of the asset in the books of Darubini Limited by the end of this year, what, 2020. So what are we going to add? What are we going to get the value of the asset? What are we going to add to get the value of the asset? What are we going to add to get the value of the asset by the end of the year? What are we going to add to get the value of the asset by the end of the year? We are going to add what? The borrowing cost. Remember, in this case, you're having to say the borrowing cost has to do what? Has to be capitalized. It has to be capitalized. In short, what you're having to say, in any case, you incur a borrowing cost. So for example, in this case, maybe facilitate the construction of an asset or a qualifying asset. You have to include it as part of what? The asset, the cost of the asset. So it means that in this case, by the end of the year, to know the value of the asset, we have to include what? The borrowing cost they incurred. So we'll include in this case what? The borrowing costs. The borrowing cost. And of course, in this case, for this one, it has been 14. Is it 14,850? Is 14? It has been 14,850. Yes, 14,850. And this one, it has been 2,700,000. So 2,700,000. So you'll be able to get 62,700. And of course, this one, you'll be able to get, is it 189,850 or something? 189,850. So at the end of the year, they'll be able to move these amounts to the statement of financial position as what? As the value of the asset. 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 So that is basically how in this case, you'll be able to determine what the actual cost of the asset by the end of the year by being able to consider what we call what? The borrowing costs. Considering what you're calling what? The borrowing costs. Remember, any other borrowing cost that in this case that has not actually been capitalized, for example, during this 3 months of inactiveness, you'll be able to take it as what? As an expense. It will be an expense in the books of what? Books of accounts. It will be an expense in the books of accounts. In the books of accounts. In the books of accounts. So the interest not capitalized, for example, for the 3 months, will immediately be expensed. So you'll basically move it as an expense to the income statement. So that's basically how you treat what? The borrowing cost. For those who missed the previous class, then watch the previous video so that you can be able to connect, so that in this case, we can actually be at par. But of course, that is how in this case, you end up having to treat what we call what? Borrowing costs. Borrowing costs. So I want us to move to another area. 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 So I want us to look at IAS 12, International Accounting Standard number 12. That is income taxes. International Accounting Standard number 12. So income taxes, income taxes, income taxes, income taxes, income taxes. So this particular term here, tax. So for those who maybe who have already been able to cover public finance and taxation. So you've already been able to come across what this kind of what a term. So it is that obligation that in this case, maybe companies or maybe enterprises are called upon to end up having to remit what? To the government. they end up having to remit what to the government. So when you talk about, in this case, the income taxes, so the income taxes here, the income taxes, they can comprise, so under the International Accounting Standard number 12, income taxes will comprise of current tax, and what we refer to as the deferred tax will comprise of what we call the current tax, and in this case, what the deferred tax. So when you talk about current tax, just from the term current, it is the tax obligation for the current year. It is the tax obligation for the current year. When you talk about, in this case, the deferred tax, is the tax that in this case you've ended up having to defer. That in this case you'll end up having to meet this kind of an obligation or pay this kind of a tax, maybe later on in future. In future. So we can be able to say, what is a current tax? You can be able to say, in this case, current tax. What is actually current tax? Current tax, in this case, it is the actual tax payable by a company. The actual tax payable by a company. The actual tax payable by a company. And it is based on the taxable profits. It is based on the taxable profits. It is actually based on the taxable profits. It is actually based on the taxable profits. So when you talk about, in this case, the taxable profits, these are simply profits that you've been able to determine. They are the ones that, in this case, you'll end up having to tax. Remember, under normal circumstances, in this case, when the accountant is preparing the financial statements or the books of accounts, he'll come up with what we call the accounting profits. The accounting profits. But of course, if now in this case the taxman is coming in to end up having to, for example, now in this case, tax the company, so this won't actually basically be the profits to be taxed. It simply means that in this case we'll have to determine what the taxable profits. And of course, these taxable profits will actually basically be dependent upon the requirements or the regulations under what the relevant statutes or maybe laws, or the requirement by the taxman or the requirement by Kenya Revenue Authority. That in this case, you don't actually tax what the accounting profits. What I mean by accounting profits, they're simply the profits you've basically been used to having to compute, in this case, as an accountant from financial accounting, even up to right now. You know that in this case, you normally take what, in this case, the sales minus the cost of sales. Then in this case, you less other expenses, including depreciation allowance for example, bad debts, like those ones. So that is basically what the accounting profits. But now in this case, when now the taxman is having to come in, he comes in with the relevant laws that in this case apply to which kind of a profit is supposed to be taxed. So in this case, there'll be the determination of the taxable profits from the accounting profits. For example, in any case, for example, there's anyone who maybe in this case has already been able to learn about public financial taxation, you'll be told that in this case, to determine which amount of profits you'll end up having to, for example, charge what we call corporate tax. You'll have, for example, in this case, do a recompute. You'll end up having to recompute the profit to be taxed. Whereby in this case, maybe you'll end up having to do maybe add back what we call disallowable expenses. Some of the disallowable expenses you'll end up having to add back is, for example, depreciation. Why do you add back? It is because it is a requirement by the taxman, by Kenya Revenue Authority, but certain expenses must be disallowed from the accounting profits. So that in this case, you can determine the taxable profits to tax using which rate? 30%, using 30%. So here, what should actually basically be going home or coming home? There are two kinds of profits here that we're having, what we are calling the accounting profits that the normal accountant preparing books of accounts will determine. But when now in this case, the company has to determine how much of its profits they are going to be taxed, they'll have to determine what we're calling the taxable profits. Taxable profits. And therefore, in this case, for each and every year, they'll end up having to determine what the taxable profits, which of course now they'll be able to compute 30% of it, which eventually becomes what the current tax. It becomes the current tax. It becomes the current tax. So in this case, you have to determine the taxable profits from the accounting profits. One of the things I'm having to say will have to be added, for example, back is what you're calling what depreciation. It is not in this case what an allowable expense. In this case, regarding what determining profits to be taxed, profits to be taxed. But of course, now in this case, you've been used to it. In financial accounting, when you are preparing the income statement, depreciation on a motor vehicle, depreciation on what you end up having to do what reduce. But of course, now in this case, what you'll end up having to consider, for example, on the taxable profit, it will basically go, for example, to call what maybe wear and tear. Wear and tear. That is basically as per the requirements of what the taxman, Kenya Revenue Authority, or the relevant what statute laws. So now in this case, I think there's a term that has basically just emerged here. So we can be able to define what are actually what taxable profits. So what are actually taxable profits? So taxable profits. What are actually taxable profits? Taxable profits, you can be able to say in this case, profits determined using profits determined. There are profits determined using using the taxman requirements or using the relevant statutes, using relevant statutes on tax. Statutes on, what do you mean by a statute? Is a law. For example, you'll be told there's VAT Act, there's, for example, Income Tax Act. So those ones basically you use them. In this case, for example, there's the pay as you earn regulations, all those ones, income tax. You must be able to observe them as in this case, you are computing what the taxable profit. So you'll have to adjust what you are counting profits. So of course, there's that other term having to come there, the accounting profits. You can also be able to indicate what are actually accounting profits. What are actually accounting profits? What are actually accounting what profits? So these are simply profits determined by the accountant. Or in this case, these are simply the profits in the financial statements. They are determined by the accountant by using what? The accounting principles, or using what? The accounting frameworks. So the accounting frameworks guide you to come up with what? The accounting profits. But you'll have to readjust them to come up with what? The taxable profits, so that you can be able to tax and get maybe what? The current tax in the current year. So in this case, the accounting profits you can be able to indicate. So they are profits determined. They are profits determined using accounting principles, or frameworks, accounting principles, or maybe what framework. So they are simply the profits that in this case you find where in the books of accounts, or maybe what the financial statements you find in the books of accounts, or maybe what the financial statements. So we've been able to say that the income taxes can actually be comprised of two. So the current tax, this is basically the tax that will be paid in the current year. But sometimes part of these tax obligations, or maybe liabilities, or maybe in this case, we'll end up having to realize that in this case, the tax could eventually become like an income. You can also, in this case, have what we call what? Deferred taxes. So in this case, what do you mean by deferred tax? What do you mean by deferred tax? You can be able to write what is actually a deferred tax. Deferred tax. What is actually a deferred tax? So it is tax payable in future, which arises. It is tax payable in future. You'll pay it in future. Remember the current tax, you are paying it in the current year. It is tax payable in future, which arises as a result temporary differences as a result of temporary differences as a result of what? Temporary differences. So in this case, the reason as to why in this case you're having to focus on now, in this case, IAS 12 income taxes, you can be able to see that the profits you get under accounting and the profits you get in this case when you want to tax, they are different. They're actually different. So what basically in this case you're trying to do here through this standard, we're trying to harmonize. We're trying to harmonize what is happening in accounting and what is actually basically having to happen regarding what maybe a tax. So that in this case, we can be able to have, for example, any form of differences having to be eliminated out and having to be determined, where in this case, there'll be obligations or liabilities to be paid in form of tax, or in this case, they can basically be the reverse, in this case, having to be recognized as what maybe incomes in what? In the books of accounts, maybe financial statements. So you can be able to see just from our discussion since we started, there's actually a very big difference regarding what? The profits you determine as an accountant and the profits that in this case the taxman is expecting, you use to do what? Determine what will be the tax to be paid by the company. So therefore, in this case, the essence of us having to, for example, study matters relating to the current tax and of course the deferred tax, we'll be able to see eventually, just from right now, how you can end up having to harmonize and realize, for example, to what extent might you have ended up having maybe to pay in excess regarding what? Maybe the corporate tax, or maybe in this case, the tax for the current year, or maybe in this case, for the deferred what? Taxes, for the deferred taxes. So we're having to say the current tax is the tax obligation or liability in the current year. But now in this case, the deferred tax, it is that obligation that in this case, you'll likely be called upon to pay by the taxman in future. You'll have to pay it in future. So this deferred tax, it is tax payable in future, which arises as a result of what you're calling what? Temporary difference. You can be able to underline this one, temporary differences, as a result of what you're calling what? Temporary differences. So of course, in this case, you can be able to see there's actually a new term that eventually has actually come up. That has actually done what? Come up. So temporary differences. So so these temporary differences, how do you get the temporary differences? Because ideally what will happen, to get the deferred tax, you'll take this 30%. Remember the current tax you're having to say you take 30% of what? The taxable profits. But in this case, for the deferred tax, you'll end up having to determine, first of all, the temporary differences. Then in this case, you take 30% of the temporary differences. You take 30% of the temporary differences, will be able to enable you to determine the deferred tax that in this case will end up having to pay where? In future. So therefore, it is a very important in this case we understand what is these temporary differences, because these are the ones that in this case are enabling us to know in this case now, in this case, what will be the deferred tax in what? Our books of accounts or in our financial statements. So what is temporary differences? What is temporary differences? So there's a formula in this case to determine what you're calling what? The temporary differences, or the TD. The temporary differences or the TD. Hope you've been able to write, because you can see I'm rubbing. Hope you've been able to write because you can be able to see I'm rubbing it off. I'm rubbing it off. So we're having to say deferred tax will eventually arise from what you're calling what? The temporary differences, the temporary differences. So the temporary differences, there's a formula to determine these temporary differences. Temporary differences, how do you get it? Differences, or in short, you just call it TD. So it'll likely basically be equal to the carrying amount of an asset, the carrying amount of an asset, minus the tax base, minus the tax base. So in this case, this carrying amount is what in this case will be determined by the accountant, or in this case you can be able to refer to it as what? As the net book value. So as the net book, in this case, when you prepare the balance sheet, you normally do what? Cost minus depreciation. Then of course in this case you get what you're calling what? The NBV. So this carrying amount is the NBV. It is the net book value. So it is the net book value. And of course, I know how you already know how to determine it. In this case, you normally do what? When you prepare the balance sheet, you do the cost. Then in this case, you minus the depreciation. Then eventually you get what? The NBV. So in this case, it is simply NBV, which is in this case just what? Cost minus depreciation. It is cost minus what? Depreciation. It is cost minus what? So this carrying amount is the one that in this case will be determined by what? By the accountant. By the accountant. So that's how you normally determine what the carrying amount. But now you have to minus what you're calling the tax base. So this tax base in this case will likely be determined by the taxman. So it will likely be determined by the taxman. So it is the amount attributable to tax in the future. So this is the amount attributable to tax, amount attributable to tax in the future. So in this case, this one is the one that will likely be determined. This one you're having to say it is determined by the accountant, as he's having to prepare normally his books of accounts. That is what you normally determine. But now this is what the taxman was actually expecting. The taxman was actually expecting, this is the amount that in this case was supposed to be taxed. It is the amount that in this case was actually supposed to be taxed. So for example, now in this case, if you're talking about maybe what? An asset. You're talking about in this case, maybe what? An asset. So for the carrying amount, you would have been able to determine the net book value. But for the taxman, in this case, you'll be told that to get the value of the asset, or the value of the asset now in this case, you normally consider, for example, things such as what we call investment deductions, or maybe wear and tear. They are the ones that in this case, you'll end up having to do what to consider. So for the taxman, he actually considered this one, investment deductions, wear and tear, that's actually provided for under the regulations. But now the accountant, he uses what has been provided as a framework, that in this case, if you are determining the value of the asset, relevant standards for accountants or principles call upon you in this case to do what? Determine the net book what? Value. That in this case will go to the books of accounts. But that is not what the taxman is expecting. For him, he has a different perspective. For him, in this case, he does what you're calling what? IDs and wear and tears. And these one are basically provided for under what? The tax laws, or are provided for by Kenya Revenue Authority. So now in this case, you can be able to see there's a difference as to how the accountant is thinking about what, for example, the value of asset, and as to how in this case, the taxman is having to think about what? The value of the asset. So the thinking of the taxman and the thinking of the accountant, if you get the difference of the two, it will be able to give you what? The temporary differences. Then once you get the temporary differences, if you multiply by 30%, then you'll be able to know in this case, what could be the deferred tax? In this case, what? In future, that will likely be called upon to be paid by the company. So it means that the tax obligation of the company will likely comprise of what? The current tax. Then of course, also in this case, you'll end up having to add what you're calling what? The deferred tax. So there'll be two obligations. The current tax, then of course, in this case, what? The deferred tax that you've been able to compute or determine, as to why in this case, we've been able to indicate here. So for example, now in this case, the temporary difference, or maybe this is the taxable temporary differences, we can be able to have two kind of temporary differences. If in this case, maybe I show you a small example. So there can be two types of temporary differences. But of course, now in this case, maybe let's see an example so that you can be able to have the perspective of, let's say, for example, we have an asset. So assume an equipment. So assume example, just a small example. Assume a company has an equipment. Assume a company has an equipment. A company has an equipment of cost. The cost is actually how much? The cost is actually, let's say, for example, 4,000. Maybe our figures are actually in thousands. So let's say, for example, 4 million. And then in this case, the depreciation on this particular equipment is actually, let's say, for example, maybe 800. But of course, now in this case, you're having to say on the side of the taxman, he normally considers wear and tear. So the wear and tear in this case, maybe let's say, for example, it is actually maybe 600. Exactly 600. So it means that in this case, for us to determine the carrying amount, we'll be able to take what? The cost minus what? The depreciation. But for us in this case, to be able to determine the tax base, what in this case, the taxman would have considered, we'll take the cost minus the wear and tear, because this one is not actually basically considered by the taxman. And in this case, in taxation, you'll likely be told that in this case, you'll have to add back what? Depreciation. when you're determining the taxable profits to be taxed by the taxman, you add back what? Depreciation. Because in this case, for the taxman, the language he understands, it is only what? Wear and tear. Wear and tear. In this case, in tax, you'd be told it is their rates. Depending upon, for example, where the equipment falls, their rates. So is it 37.5%, then 30%, then I think 25, then I think 12.5, something like that. So that is what the language the taxman understands. So you can be able to see there's a difference as to how the accountant is actually thinking. And of course, now in this case, what the taxman is having to think about what is actually supposed to be what to be taxed. So therefore, in this case, if you use this particular simple example to be able to get the temporary difference, in this case, it simply means that our TD, our temporary difference, in this case, will likely be equal to what? It will likely be equal to the carrying amount of the NBV. So in this case, you'll be able to take 4,000 minus 800. So 4,000 minus 800, you'll be able to get, in this case, the net book value. Then in this case, we'll be able to take the tax base, so minus the tax base. The tax base, we've been able to say they are considering what? They're only considering, in this case, what? Wear and tear. So it means that in this case, for our tax base, it will likely be 4,000 minus 600. Minus 600. If you compute the difference, what are you getting? The difference, this is actually minus, because you can be able to say there's a minus. So the carrying amount is this one. Then of course the tax base, what the taxman is having to consider is the wear and tear, is this one. So it means that in this case, our temporary difference will be what? Our temporary difference will be what? What is our temporary difference? Our temporary difference will be this one, the figure you get here minus the figure you get here. What are you getting? You are getting a negative of what? Of 200. A negative of 200. A negative of what? Of 2. So this basically becomes what? Our temporary difference. It becomes our temporary difference. So in this case, when it is negative, we refer to it as what? A deductible temporary difference. But in this case, when you get it as a positive, it will likely be a taxable temporary difference. So in this case, if it is negative, it will be a deductible temporary difference. If it is positive, it will be a taxable temporary difference. But in simple terms, basically, that is how you arrive at what? The temporary difference. So therefore, in this case, there's something I'm having to bring upon, that in this case, we have what? The types of temporary difference. They can be two. We can have deductible, and we can have, in this case, what? Taxable. So if it is negative, it will be deductible. If it is positive, we'll be able to refer to it as what? In this case, taxable temporary difference, taxable temporary difference. So you can be able to write something briefly, the types of temporary differences, the types of temporary differences, the types of temporary difference. They are of two. There are two. So in this case, you can be able to have the types of temporary differences, types of temporary, the types of temporary differences, the types of temporary differences. So the types of temporary differences, in this case, number one, we can be able to have taxable temporary difference, taxable temporary difference, taxable temporary difference, taxable temporary difference. In this case, we've been able to say if it is actually what? Positive, if it is actually positive. This means it is this kind of a temporary difference, it will give rise to a deferred tax liability. It will be able to give rise to a deferred tax liability. It will give rise to a deferred tax liability. It will give rise to a deferred tax liability. It will give rise to a deferred tax liability. In this case, we have deductible temporary difference. That is, in this case, you eventually get it as a negative. So if it is actually a negative, so this one will give rise to a deferred tax asset. It will give rise to a deferred tax asset. Tax asset. It will actually basically eventually become what? An asset. So so in this case, for us to get the deferred tax, then we would have been told, for example, the corporate tax rate is 30%. So that means that in this case, we'll be able to take 30% of the temporary difference. We've been able to get either positive or negative, then we divide. So, but in this case, we're having to define it as a positive. It will be a liability that we'll end up having to pay in future. But you're having to define it as a negative. It will be a deferred tax asset that we'll be able to enjoy what in future. So that is in this case how you end up having to arrive at what you're calling what the temporary difference, the temporary differences, the temporary differences. So I want us to look at an example. 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 An example, I think I was able to share it. So it is December 2012, question number 2. Question number 2. It is actually on the group. I don't know if you can be able to get it. Inform me whether you can be able to see the question. December 2012, question number 2. I had shared it on the group. I don't know whether you can be able to see it. December 2012, question number 2. I had shared it on the group, WhatsApp group. Inform me whether we are together so that we can be able to start on the question. We can be able to start on the question. December 2012, question number 2. I had shared it on the group. Just confirm whether you can be able to see the question so that you try to understand the language you are trying to talk here. What are we having to say here? We can be able to use an example so that it can be able to go home. The points can go home. Are you seeing the question? Amos ni kama ameingia saa hii sasa hata. Sijui kama anajua penye tuko ama ajui penye tuko. Anyone who can be able to confirm, at least 1 or 2 or 3 people should be able to confirm. At least they have been able to. I shared it as a photo. I shared it as a photo on the group. I can see T says yes, but Eden, you're not saying something. Eden, you're not actually having to say something. Eden, you're not having to say something. I can see Ikapel says yes. I can see Muteti says yes. I can see you are saying received yes. You can be able to see it. So the question, I think the question reads, it is part B. We'll tackle first of all part B. Part B. We'll tackle first of all part B. Part B. But I think part A we've already been able to answer. So the taxable temporary differences, and actually it is here. So it is eventually in this case when you get what a positive temporary difference, which eventually in this case gives rise to a deferred tax liability, and the other one is actually this one. So I want us to look at part B, which says equip agencies sorry. Equip Agencies Limited purchased equipment for 4 million on 1st of July 2008. Depreciation on equipment is provided on a straight line basis at the rate of 25% per annum. During the 4 years from 1st of July 2008 to 30th of June 2012, the profit before tax and allowed wear and tear charges for tax purposes were as follows. So we have in this case the first period there, which you're having to see that it was actually the profit before tax was 800, then 900, then 950, then 850. The wear and tear in this case, like the one we were looking at, this one, the wear and tear was this. So remember, this is the depreciation being told was actually what 25% on the cost. It was actually the depreciation was actually 25% of the cost. The wear and tear you're having to be given there. The first year it was 40%. The next year it was 30%. Then eventually 20%. Then eventually kaisha kabisa 100%. It eventually went to 100%. But now the depreciation, they were doing 25% per annum. 25% per annum. 25% what? Per annum. 25% per annum. So you are required to, in this case, come up with the taxable what? Profits. Then the temporary differences. Then the deferred what? Tax account. Deferred tax account. So remember in this case, there's something we're having to say, that we have what we're calling what the accounting profits and the taxable profits. The accounting profits, and we have what we're calling what the taxable profits. So what we've been given here, the profit before tax there on that table, it is the accounting profits. It is the accounting profits. It's the profits in the books of accounts or financial, the ones that the accountant determined. But now you're having to say, when the taxman wants to collect his tax, it doesn't depend upon that kind of a tax, because in this case, it is a requirement under the regulations or under the laws that this kind of a profit has to be adjusted. For example, in this case, you have to add back depreciation, because when you're calculating profit to be taxed, you don't less depreciation, because now in this case, actually depreciation doesn't represent real outflow of cash out of the business. It is just an indication of a reduction in the value of the asset, but it doesn't indicate real cash outflow out of the business. So therefore, in this case, that is not the expectation of the taxman when you're having to determine what the amount to be taxed. So it means that in this case, what you're having to see in the books of accounts here, 800, 900, 950, those are the accounting profits. But you have to readjust them in this case so that we can be able to do what? Determine the taxable what? Profits. The taxable what? Profits. And of course, in this case, we've been able to say in the mindset of what? The taxman, he only basically considers what? Wear and tear. He doesn't consider in this case what? Depreciation. Whenever, for example, in this case, he's having to do what? Determine what you're calling what? The profits here. Is determining the profits here. So we can be able to have our table there. We can be able to have our table there. So I think I'll be able to ramp. Let me ramp so that you can start the computations. You can be able to start the computations. Let me ramp. So the part question in this case wanted us to determine what? The taxable profits. So we have a number of years there. So so the first one is determination. It is December. It is December 2012. The question is December 2012. And you need to write the question so that when you are revising, you can be able to. It is December 2012. Question number 2. December 2012, question number 2. So determination of the taxable profit. Determination of the taxable profits. Determination of the taxable what? Profit. So we have 4 years there. So you have in this case 2009. 2009. Hope you people are able to see. 2009. Then you have 2010. 2010. We have in this case 2011. 2011. We have in this case 2012. 2012. So I think our figures are actually in, can put them in thousands. There are figures in thousands. You can put them in thousands. And put our figures in thousands. So remember, in this case, actually this particular point will be able to sink when you learn. Those who already learned public finance and taxation, they are really understanding exactly what I'm having to say. But hope the point is actually going home. That in this case, you'll have to readjust what the accounting profits for you to come up with what the taxable profits. In this case, in public finance and taxation, will be told you start with maybe the profit realized. Then in this case, you add back disallowable expenses. Then in this case, you less disallowable incomes. There are, of course, also those incomes that in this case, probably the taxman won't be able to consider them as part of what is actually supposed to be taxed. So you have to less them. Because they'll be increasing the profit, you have to less them. Because the expenses that you are not allowed, they'll be reducing the profit, you have to add them back. So in this case, the profit before tax as per the books of accounts. So the profit before tax, as per the books of accounts from our table there, you can be able to see it is 800,000. Then in this case, we have 900,000, then 950,000. And in this case, we have 850,000. But now we've been able to say when the taxman is having to consider the taxable profits, he doesn't consider depreciation as an expense. Remember, the depreciation had been reduced to get the profit before tax. So when you're computing profit before tax, you normally take the GP minus depreciation and other expenses. But now the taxman doesn't consider depreciation as an expense whenever he wants to know how much tax is supposed to be, for example, be gotten from the company. So you'll have to add back the depreciation. Add back depreciation for each and every year. And of course, now in this case, we've actually been told that depreciation was actually what, on a straight line basis, that is what, 25% per annum. So that means that in this case, our depreciation will be how much? It was 25% per annum straight line on the cost of what, this equipment. So our depreciation will actually be how much? It will actually be how much? It was actually on straight line. It will actually be how much? 200,000. T says 200,000, 100,000. Remember, we're having to say equip agencies purchased equipment of 400,000 on 1st of July 2008. Depreciation on equipment is provided on a straight line basis at the rate of 25% per annum. Remember, depreciation is actually what, on the asset. So it will be how much each and every year? I can see Leonard says 1 million. Elizabeth says 100. So I don't know how Elizabeth is getting 100. It is 1 million. So it is 1 million. So the depreciation that in this case they considered when they were coming out the profit before tax, it was on that equipment. And of course, they're having to say each and every year, they're having to do what? Reduce it by 25%. So it means that in this case, we'll have to add back a depreciation of what? 1 million. 1 million, 1 million, 1 million. Remember, our figures are actually in thousands. So 1 million, 1 million, 1 million, 1 million. But now in this case, we've been able to say, for the taxman, the language he understands is actually what? Wear and tear. Wear and tear. So we'll add back, of course, depreciation, but of course, we'll have to less wear and tear. That is the language he understands. Wear and tear. These things about depreciation, he doesn't understand that kind of a language. So in this case, you have to come up with what the wear and tear. We've been told that allowable wear and tear in our table, allowable wear and tear charges were how much? So in this case, we have for, we can do a working year. We can have a working year. So for what? Wear and tear. Wear and tear. We can have a working year for wear and tear. So in this case, we'll be able to have for the year 2009, it will be 40% of 40% of the cost of the asset, 40% of the cost of the asset, 40% of the cost of the asset. And then of course, in this case, 2010 it was 30% of the cost of the asset. Then 2011, it was 20% of the cost of the asset. Then 2012, it was 10% of the cost of the asset. So for the first year, it will likely be how much? I think it is 1,600 or 1.6 million. Remember, our figures are actually in thousands. They're actually in thousands. So this one will be 1.2 million. This one will be 800, I think 800 or something, 800K. This one I think will be 400. So that will be our wear and tear. So we'll less the wear and tear because that is the language the taxman actually understands. He doesn't understand about what depreciation as what is actually supposed to be reduced on the asset or as an expense. So 1,200, then we have 800. Then in this case, we have 400. So for the first one, now in this case, the taxable profits will likely be how much? The taxable profits. So the first one you're getting what? The first one you're getting, you can basically give me the figures. So for the first one is how much? For the first one is how much? It is 200. Yes, it is 200. Second one. The second one is how much? The second one is how much? 700. It is 700. The third one. 1150. 1150. And of course, the very, very last but not least, 1450. It's 1450. So that's actually 1450. So if you look at the question, they're having to say the corporate tax rate is actually what, 30%. The corporate tax rate is actually what, 30%. So of course, now in this case, they have not actually called upon us to determine what, they have not actually called upon us to be able to determine the current tax. But in any case, they had asked us to determine the current tax. The current tax would have been now 30. If it's actually 30, you can see 30%. It would have been 30% of these what, taxable profits. So that is the tax that in this case they'll end up having to incur in the each and every current year. So the 30% of this taxable profit, 30% of this, 30% of this, 30% of this. That will end up having to be the current tax. So in the case they had asked the current tax, you would have taken the current tax would have been in this case 30% of this one. So which eventually in this case, this one is actually 60. This one, I think it is 210. This one is how much? This one will be 1150 is how much? This one will be 1150 is how much? The one for 1150, if we were to determine, remember our answers ended here. That is what the examiner wanted. But in any case, they had asked the current tax then. Since the corporate tax rate to be given is 30%, would have taken 30% of what the taxable profits. So in this case, the current tax for this one is 60, this one is 210, this one is how much? It is 345. Then the last, exactly 345. Then the last one, 435, 435. So thank you very much, exactly 435, 435. So we've already been able to finish up with what? The first part. So the first part is actually done and dusted. Exactly done and dusted. So now in this case, the second part, they want us to get what you're calling what? The temporary differences. The temporary difference. So the second part, they want us to get the temporary differences. 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 They want us to get the temporary differences. The temporary differences. So they want us to get the temporary differences. The temporary differences. The TD. So determination of the temporary difference. Determination of the temporary difference. So the second part is determination of the temporary differences. So of course, in this case, as per our formula, we've been able to say temporary difference is equals to what? The carrying amount minus what? The tax base. The carrying amount, this one is actually equal to what? The carrying amount minus the tax base. The one that in this case, the taxman understands. So this one, it is the net book value. In simple terms, Eden, what you're having to say, that this one, you simply just take the cost minus what? The depreciation. The cost minus what? The depreciation. So just take the cost minus what? The depreciation. Of course, now in this case, you'll be able to get what? The tax, the carrying amount. The tax base, in this case, you take the cost, because the language the taxman understands, tax ni wear and tear. You minus the wear and tear. You minus the wear and tear. Then, of course, the difference, you'll end up having to get what you're calling what? The temporary difference. So we'll have the period. We can go to have our table here. Hope you people are able to see the period. We can have the period. Then we can be able to have the carrying amount. Then in this case, you can be able to have the tax base. Then of course the difference will be able to give us what? The temporary difference. So the difference when you minus. But of course, in this case, we've been able to say that the carrying amount will be the costs of the asset minus what? The depreciation. So that's what we've already been able to say. But of course, in this case, our tax base will actually be the costs minus the wear and tear, because the language the taxman understands, it is wear and tear, not depreciation. And of course, we've been able to say when you're determining the taxable profits, we were able to add back depreciation because we less the wear and tear. So remember, our figures actually were in thousands. So we can basically put our figures to be in thousands. Our figures are actually in thousands. They're actually in thousands. So don't forget that. They're actually in thousands. So we have, in this case, 4 years. So we have 2009. We have, in this case, 2010. Then we have 2011. Then we have 2012. 2012. So for the cost of the asset is how much? It is actually 4 million. Simple 4 million. In this case, it simply means that for the first year, 2009, the cost was actually 4 million. The cost was actually what? 4 million. But now in this case, we in that year we incurred a depreciation of how much? It was actually of 1 million. 1 million. It means that by the end of the year 2009, our net book value was actually what? 3 million. 3 million. So hiyo inamaanisha 2010 tulifungua na ngapi? Tulifungua na 3 million. Tulifungua na 3 million, but pia sasa less because it was on straight line. So ikabaki 2 million hapa. Ikabaki 2 million hapo. Then 2011 tukafungua na 2 million. Tukang'oa 1 million. Tukabaki na 1M by the end of the year 2011. Then 2012 sasa ilikuwa ni kumalo. Tutoa kabaki na 0. So this is basically the NBV for the end of each and every year. The NBV for the end of each and every year. So the net book value of this equipment was 3 million by the end of 2009 because the depreciation was actually 1 million. Then next year wakafungua na 3M because ilikuwa imepungua wakapunguza tena. By the end of it was fully depreciated 25% ilishia 2012. But now in this case, our tax base. So for our tax base, we're having to say the cost, because the cost here is actually what? 4 million for the first year. But now the first year wear and tear, our wear and tear kwenye tulicompute ilikuwa ngapi? The first year ilikuwa 1600. So it was 1600 years. I think it was 1600. So tulibaki na ngapi? It was 2,400,000. So wakafungua the coming year na 2,400,000, waka reduce na 8. The next one I think it was 1,200. So they remained with 1,200. So 2011 wakafungua, iliendelea wear and tear kiisha your equipment. So it basically ended up having to have these 12. Then the wear and tear, I think it was 800. It was 800, yes. It was 800. So they remained with 400. Then in this case, the 400 was worn out completely in the final year. It was actually worn out completely in the final year. So these are basically the wear and tears. So we can be able to see we've already been able to determine what the NBVs. We've already been able to, in this case, also determine what the tax base. And of course, we've been able to say for you to end up having to get the temporary difference, get the difference between the two. You eventually get what the difference between the two. So for the first one, in this case, if you take 3 million minus 2.4 million. So remember, in this case, you have to remember you are lessing these ones. So just sasa kuna one of my students hapa atasahau, anaitwa Amos. Don't forget, we are now minusing. The carrying amount is this one. The tax base is this one that we've been able to determine. So you're minusing. So in this case, you get for the first one here, it will actually be 600. I think this one will be 800. This one will be, is it 600? 600. This one will be 0. It will be 0. It will be 0. It will be 0. So the temporary difference for 2009 was actually 600. This one was actually 800. This one was actually 600. This one was actually what? 0. Was actually 0. So that is basically, in this case, eventually you get what you're calling what? The temporary difference, or the TD. The temporary difference or the TD. The temporary difference or the TD. So we can take a small break of 3 minutes. Then when we come back, I would like in this case to show you how, in this case, if you are called upon to determine the deferred tax. If you are called upon to determine the deferred tax, in this case, how would you have ended up having to do what? Compute. So a break of 5 minutes, then we come back. Yes, I think we can proceed. Can we proceed? So confirm whether we can proceed. Can we proceed? I want us to determine what you're calling what the deferred tax. What if in this case, we were called upon to determine the deferred tax? How would we have gone about it? What of, for example, in this case, we were called upon to determine the deferred what tax? What of if we were called upon to determine the deferred tax? Of course, those were the temporary differences. The temporary differences. And now, out of those ones, maybe you can be called upon to determine the deferred tax. The deferred tax. Maybe you can actually be called upon to determine the deferred tax. So in any case, for example, so if we were to determine the deferred tax, if we were to determine the deferred tax, in this case, determine deferred tax. The deferred tax, how would you have ended up having to arrive at it? So so we have in this case the period, we have the period, so the period here, we have 2009, we have 2010, we have 2011, we have 2012. So so directly the deferred tax here, the deferred tax, remember this as I indicated earlier, you simply take the tax rate multiply by, in this case, what? The temporary difference, So this will actually basically be the tax rate multiplied by the TD, or the temporary differences. So in this case, for our first year, it will actually be 30% of the temporary difference, which is actually 600, 30% multiplied by 600. I think you'll get something like, is it 180? You'll get 180. The next one will likely be 30% of in this case, what we got as TD, it was 800. So this one will come to, is it 240? I think 240. Yeah, is it 240 years? 240. Then in this case, the 2011 will likely be 30% multiplied by 600. It will be 600 is equals to 180. This one was actually 0. It was actually 0, 0, 0, 0. So 0, 0. There was no TD there. There was no TD there. There was no temporary difference there. So this is basically the deferred tax. The deferred tax in this case, this is actually the deferred tax. The deferred tax. So for example, now in this case, in the year 2009, this is actually what's an increase of 180. It is an increase of what? Of 180. So this particular increase will actually eventually be treated as what? As, of course, what? An expense. It will actually basically be an expense. So whenever in this case, for example, the deferred tax has actually increased, so you are basically increasing this particular liability or this expense. So it basically is an increase, it is an expense. But for this particular year here, you can be able to see. So the previous year it was 180, but now this particular current year is actually going to 240. So it will basically be 240. The coming year it increased up to 240 minus 180. That basically comes to 60. So it is still an increase. It is still an increase, which will likely still be an expense. It is an increase which will likely be an expense in the books of accounts. So you'll be able to treat this particular deferred tax. You'll add it on the current tax. You'll add it on the current tax as part of what? The tax liability. Remember, the current tax is the one we are computing hapo nyuma, ile 30%. So it means that for the year 2010, you'll take that current tax and, of course, basically include this one. Because you're actually carried forward this one, you'll end up having to reduce on the subsequent years what? Deferred tax by the end of the year. So by the start of the year, you are having this one. By the end of this year, you're having 240. So the difference, there was an increase. Actually, when ukifungua mwaka 2010, deferred tax liability yako ulifungua na 180. Then by the end of the year, ukafunga na 240. Inamaanisha during the span of the year, there was an increase of what? 60. Therefore, it becomes what? An expense. So it will go to the tax liability, you'll accrue it as part of the current tax. That basically enable you to determine what the tax liability for the whole year. So it will be the current tax plus this deferred tax of increase of 60. It will basically go to go there as an expense. But now you can be able to see the opposite is happening here. The opposite, I think, is actually happening here. That what happened, you by the end of the year 2011, you had in this case what? You had in this case, is it 240? So you had in this case 180. But at the start of the year, you had 240. So it basically brings to you what? A negative of 60. So by the start of the year, you are having what? 240. But by the end of this year, 2011, the deferred tax liability had reduced. Remember, this one you carried forward as a balance carried forward. So it was brought down in 2011. But by the end of the year 2011, the deferred tax liability had moved from 240 by the start of the year. It had moved to 180. So it means that in this case, there was a drop, or there was a negative of what? 60. If this is the case, if it is basically a decrease, if it's actually a decrease, then you treat it as what? As an income. So a decrease in this case will likely basically be treated as what? As an income. As an income. As an income. Then in the very, very final year, so it was 0, but now in this case, you closed with what? 180. So it will likely basically be 0 minus 180. So in this case, you get a negative of 180. So still, it is actually a decrease. It is actually a decrease, which eventually in this case also you'll be able to treat it as what? As an income. You'll be able to treat it as an income. So that's basically how in this case, you'll eventually determine the deferred tax liability. Then of course the deferred tax. So this is basically the deferred tax by the end of the year. But of course in this case, the deferred tax expense, you'll basically consider whether there was a decrease or an increase. A decrease, or maybe in this case, what? An increase. So in short, if we open very quickly our deferred tax account, it simply means that in this case, by the year 2009, so by the year 2009, I don't know whether we can be able to wrap. So let's wrap. Hope you people have been able to copy. So this basically is that now you are going to see why we're having to say there'll be these increases or decreases as you're having to see what from the income statement. So we can be able to draw the deferred tax income statement, not income, deferred tax expense account, because that is the final part of the question. I think they were asking the deferred tax account, the deferred tax expense 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 account. The deferred tax expense account, the deferred tax expense account. So if we open it, So remember, our shillings are actually in thousands. Our shillings are actually in thousands. So we start with the first year, which is actually 2009. For 2009, tulianza na 0. But by the end of the year, tulikuwa na ngapi? 180. From just what you computed from the table above in your book. So tulianza na 0. But by the end of the year, it had increased by 180. So in this case, the balance brought down for 2009 in this particular account, because it is basically a deferred tax liability account, is actually a liability. It's supposed to be deferred tax liability account, not expense, but liability account. So just be able to refer to it as a deferred tax what account. So by the start of the year, the deferred tax liability was actually 0. So the balance brought down for 2009, it was 0. But you can be able to see by the end of the year, the balance carried down was actually how much? It was actually 180. So the balance carried down by the end of the year, was actually what? 180. So, and of course, you've been able to say you'll be able to take to the P&L or income statement as an expense. Remember, in this case, if you're having to, in this case, do what? Credit here, it means that you'll debit in the P&L account. So it will basically go there as an expense. It will go there as an expense. So it will go to the P&L on the debit side as what? As an expense. That's what you're having to say now. That our table above there, the computations we've done, so G180 minus this negative. So that's why in this case, by the end of the first year, it had increased by 180. So the P&L expense will actually be 180. So this will be able to go to the P&L account as an expense. But now in this case, the coming year we had, that is 2010. So we have a balance brought down. So the balance brought down of what? 180. So the balance brought down is actually 180. But by the end of the year, our balance carried down, that is 2010, is actually how much? It is actually 240. So the balance carried down by the end of the year 2010 is actually 240. Is actually 240. 240. So there was an increase of 60. So the total here you can be able to see it is 240. It is actually what? 240. So of course the difference basically goes to the P&L account on the debit side as what? As an expense. So that's basically what? 60. That's why I was telling you above there, before this one, it will be an expense. So now you could have been wondering, what his mwalimu saying is an expense, it is what and what. So that's basically how it is arriving as an expense. It is arriving as an expense. So of course, now in this case, you carry forward, that is 2011. So the balance brought down is actually how much? Is actually 240. 240. But now that one, by the end of the year, the balance carried down was actually how much? It was 180. So the balance carried down for 2011. Balance carried down for 2011 was actually 180. It was actually 180. So you can be able to see now in this case, the difference is actually on the debit side. So it means that this side is actually more, that is actually 240. 240, so this one is 240. So it means that the 60 basically will go to the P&L or the income account as what? As an income. You can be able to see it is going on the credit side. When it goes on the credit side of the income, the double entry, that other side, it simply means that in this case, it is exactly what? An income. An income. Sasa aki Eden soon nimalizie hiyo ya mwisho. Sababu hata my board is almost full. So the last one, wacha tu tumalize. Brenda atasema tu mwalimu hakumaliza. Wacha tu tumalize. So you continue down there. You continue down there and we want to do for 20, that is what 2012. 2012, we want to do for 2012. We want to do for 2012. So for 2012, in this case, the balance brought down. So that is 2012. You just continue with your table. Don't grab or don't create another one. That is 2012. So in this case, we have the balance carried down is 180. So in this case, it simply means that the balance brought down here. The balance brought down here is actually 180. So it means that for this one, by the end of the year, what went to the P&L account was actually 180. Then we close. We close na tunafunga. Finish hapo. Finish kabisa. So this is why it will go to the credit side of the income statement. So to the P&L, so it will be an income. That's why kako katebo kako juu hapo tukifanya hizo mahesabu pia, you are having to see, I'm having to say it will go there as an income. It will go there as what? As an income. So that's basically what the deferred tax liability account, the deferred tax liability account, the deferred tax liability account, the deferred tax liability account. So we can end there. We can end there. But now I leave a question so that you can be able to also look at it. So April 2022, you can look at April 2022. Maybe we look at it in our class before we start the next area. April 2022. 2022. It is question number 5B. So take note of this particular question. You can attempt it as an assignment. You can attempt it as an assignment. April 2022, question number 5B. So I don't know if there's any question up to that point in time. Any question up to that point in time? Because we are going to end there for now. We're going to end there for now. So when Dr. Joshua comes in, he'll be able to take you through another topic. So we won't be doing the same topic. So there won't be any form of clash. Where he left is where he'll be able to pick up from. So what you need to do, you can be able to arrange your book so that in this case, probably from behind, it is his work. From the other side, it is my work. Then there'll be no problem. There won't be any form of clash. So he'll be able to tackle another topic. But when I come in, probably will be able to pick up from here. Maybe we'll go through that question, but first of all, try to attempt it. If you come across a challenge, then you can be able to reach out. So I don't know if there's any question. Brenda, have you been able to grasp something about income taxes? Maybe part of it could have escaped, but have you been able to grasp something about income taxes? Amabaduko blank. Betty, have you been able to grasp something about income taxes? About income taxes. Eden, about income taxes. About income taxes. I can be able to see Ekapel says, I think that the classes are 4, so I'll be doing 2, he'll be doing 2. I'll be doing 2, he'll be doing 2. So that just it'll be like that. He'll be doing 2, then I'll be doing 2 like that. He does 2, then I do 2 like that. But of course, not all the classes are falling on the weekend, so it can't be possible I'll do all of them weekends. You can be able to see. You can be able to see. So it means that one of the classes has to be on the weekday. So it has to be on the weekday. It has to be on the weekday. But of course, you'll be able to just agree. Hope you've gotten lost on the double entry here. So we've said, remember this one, the balance carried down here, 2011 to Kipeleka 2012, it will be the balance brought down. It is here. It is here. It is actually there. So it means that in this case, by the end of the year, you'll be able to close to the P&L account by 180, which will basically eventually become what? An income. It will become an income in the P&L. So we'll close to the P&L, that amount. Remember, you are closing with what? The P&L. We are closing with the P, and the difference basically is going to the P&L. The difference here is basically going to the P&L. So this particular balance carried down here, you can be able to see we've been able to bring it down here. And the difference, which is actually 180, we close it to the P&L account as what? As an income, because it is on the debit side here. In the P&L account, it's likely on the credit side. In this case, it is on the credit side, it is an income. But if it's actually on the debit side, like the other ones that were actually on the debit side of the P&L, they were actually what? Expenses. So hope are we together? Hope are we together? You've gotten, so it is this 180, we've been able to bring it down here, but we close it to the P&L account. So for that, this particular year of 2012, this particular amount of 180, you'll basically take it to the P&L account as what? As an income. As an income. As an income. Hii account imekataa. Hii account imekataa. So maybe in this case, we'll be able to repeat next time. But it's just double entry. It's the concept of double entry. We say that in this case, in double entry, when one account is debited, there's another one having to be credited. When one account is having to be debited, there's another account having to be credited. And it is the rule of the thumb. Is the rule of the thumb. When you debit the P&L account or the income statement account, that is an expense. You always debit all the expenses. You debit all the expenses in the P&L account. You credit all the incomes in the P&L account. It is just the rule of the thumb. There's nothing you can change about it. All incomes are credited in the income statement. So the double entry, like for this one, when there's always one account having to be debited, there's another one having to be credited. So of course, the one that is having to be credited, it is the income statement. Is the rule of the thumb. All credit entries, in this case, in the income statement, are incomes. In this case, this one basically will go there as an income. So if you're having to debit this account, you need to ask yourself, which other one is having to be credited? It is the P&L account, which is, of course, here. So the difference, basically, we're having to close it in the P&L account. Of course, if there is a debit entry here, then it means that in the P&L account, it will be a credit entry. It is the rule of the thumb. All credit entries in the income statements are incomes. All debit entries, in this case, basically, they end up having to become what? Expenses. They'll become expenses. That is double entry, double entry. Double entry. So I can see, Eden, you're asking, this topic is under accounting for assets. Yes, it is under accounting for assets. Current and deferred tax. I think you can be able to see something like that. So the other areas which you haven't covered, like leases, but we'll be able to cover them. We'll be able to cover them. So remember, for this, for FR, there's the approach. We don't go for the approach of going topic-wise, because some of the topics are related to others. For example, you have to cover other topics before you can cover another one. So it is usually that kind of an approach, whereby a concept, for example, in this topic, you'll build up on it in another topic. So that's why in this case, the flow, you can't exactly follow the flow from the first topic going like that. But just rest assured, all the topics will be covered. Will be covered. Will just be covered. Yeah, so I think we can end there. We can end there. So hope our friend, you'll try to go through that account just keenly. You'll be able to get it. But of course, maybe we'll be able to repeat next time. So you people can start enjoying the weekend. So you can start enjoying the weekend. So we catch up later. We catch up later. Thank you very much. Thank you very much. Thank you very much.